For Morningstar, I'm Jeremy Glazer. The Department of Labor released their final rules on the new fiduciary regulations. I'm here with Scott Cooley. He's our Director of Policy Research for his first take. Scott, thanks for joining me.
Thank you.
So we hear a lot about the DOL, these fiduciary rules, fiduciary regulations, fiduciary responsibilities. Can you help kind of demystify this a little bit? What are these new regulations?
Yeah, in short, these regulations are intended to ensure that if someone gives you advice on a retirement account, he or she is acting in your best interest. And that person could be a broker, a registered investment advisor, or a plan provider on the 401k side.
So what's kind of the bar for that of working in your best interest? How is that determined?
Yeah, I think one way an advisor can meet that standard is by charging a fee, flat percentage of assets that will not vary depending on what the product is that's sold. Another way to do that is to sell products that might even have a commission, but to enter into a contract with the individual saying that you will act in his or her best interest. And then the enforcement mechanism is if you were an advisor or a broker-dealer that was consistently not acting in people's best interest, there's a high likelihood of a class action lawsuit being filed.
So these rules have gone through a couple of different iterations. Now we're at the final one. What's changed? What are the major differences?
Yeah, I think the first proposal from the DOL that came out last year actually would have been very difficult to implement, would have raised costs for the industry, and those costs would have been passed along to investors. So in some respects, it was kind of impractical. And I think in this version of the rule, the DOL has really listened to feedback and attempted to come up with a pro-investor way of implementing the rule.
So what are some of those changes that are more pro-investor?
Yeah, one that I like a lot is that there will be a higher bar for a broker to switch a client from being in a commission account to being in a fee-based account. And that sounds like a good thing, but you can imagine a situation where a client just paid a big commission earlier this year and then wouldn't really be on the hook for high payments to the broker in the future, but then there would be switched over to an account where they're probably paying 1% of assets. And so the Department of Labor is going to make it so that brokers who move people over into those types of accounts actually have to act in the best interests of the client.
Now, when you, from an investor's perspective, do you think these rules are going to make a big difference, that there's going to be a lot of positive impact from this, or is it too early to say?
So if you're a self-directed investor, this rule probably won't have a lot of impact on you. This will really affect more of the people who work with financial advisors or who rely on their plan providers for a lot of advice. I do think one impact of the rule will be that more money will stay in 401ks. It'll be harder for an advisor to justify rolling it over into an IRA. And I think for everyone who's in the 401k, that's a good thing because as assets go up, the expenses usually go down.
And then what about for kind of the industry? Do you expect that there's going to be any large changes? I know there were a lot of objections before this final rule came out. Would you expect any big changes on that side?
Yeah, well, we do believe that low-cost providers are going to be net winners on the fund management side. So if you think about the Vanguards and ETF providers like BlackRock, they'll probably be net winners. We do think this makes it harder to do right commission business. Now, there are lots of broker-dealers who are going to continue to write that sort of business, and in fact, we've been in discussions with many of them about ways they can comply with the rules. But on the margins, it'll probably continue that migration away from load funds to lower cost products.
Now, this is a Department of Labor rule, really deals with retirement accounts. What about non-retirement accounts? Will they not be regulated under these new rules?
They will not be regulated under these rules. So the SEC does have the authority given to it by Congress to write a uniform fiduciary rule that would affect retirement and non-retirement accounts. But so far, it has been unable to achieve a consensus within the commission about how to proceed. And in fact, the chair of the SEC has said that is not likely to happen during her tenure.
So overall, do you see this rule as really kind of a game changer for investors, for the investment community? Is it more of a evolution of what's already been happening?
I think it hastens some of the trends that we've already seen toward lower cost investment products, for example. And I think the DOL listened to feedback, and at first glance, I need to do more analysis of the proposal, which is quite long. It actually listened and did a very good job of listening to that feedback and trying to rewrite the rule in such a way as to make it even more pro-investor in some respects.
Scott, I appreciate your early take on these new rules.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.